Hi, investors. It's Nick and
From Martin.
Hi, it's Tom here. Sorry, I'm muting my mic.
delayed reaction. Anyway, right. So plan is today to talk about the high level economics stuff. We're going to go through the property cycle, where we are in the cycle at the moment, how Manchester essentially shapes up relative to that cycle. And then we've got an example property which we know was in demand because it sold very quickly, but we're going to show you that property and the guys are going to talk about that because that's their thing. And broadly, we're just going to put a thesis together in favor or not, because we might find that things don't make sense, but I'll give you a clue. I think they do. And I think they do if you're buying with cash. And I'm going to go through that thesis. So, all right, with no further ado, let's share screen and let's get into it. So there's our specimen house, which we're going to talk about a little later. Now, the very first thing I want to just explain is that there is such a thing as a property cycle. And here we have some pictures. And this is an example of a chart which was put together by Schroders Bank, talking about the relationship between property prices and average earnings. Now, if you're into all this kind of stuff, you may have seen me talk about this in the past. But essentially, each red arrow represents a peak of unaffordability, essentially. So this is the ratio of wages to house prices. And you can see each arrow is roughly on average 18 years apart. And now we've had another peak. This is going up to 2019, but if we were to kind of extrapolate, we'd have another peak over here on the right. So this notion that of markets in cycles, it's a real thing and it's persistent. Here's another example, just looking at cycles around affordability. So I did some research prior to this, obviously, as preparation. And one of the most interesting charts I've seen recently is the relationship between mortgage payments and take-home pay. And this is an old one, which I've talked about incessantly. But essentially, when you go back, what happens at the peak of a property cycle is property becomes unaffordable, and then affordability returns as prices decline. Now, they can either decline in nominal terms, i.e., as was the case in 2008, or they can decline in real terms when you adjust for inflation. So right now we've got an interesting phase, I suppose you could say, in the cycle. So this is the market going back to the writing's very small down here, but 1984 through to now. And this last area here, 2005 to 2008, was the end of the previous cycle. And now we're on to the next one, obviously. So it's a lot less aggressive than the cycle before that. And there's a simple reason for it, which is interest rates. And if we look at this chart here, we can see long-term interest rates going back 120 years or so. And here we have 1900 on the left. And then as we move forward, we have various cycles and so on. So we've got interest rates and we have inflation. And one of the most interesting aspects of this chart, for me anyway, is the behavior of the markets, or the interest rate environment in the 1940s. So it's very similar to where we are now, in that the 20s was a boom period with relatively low inflation, high asset appreciation, then a huge crash, then a very sporadic recovery, then a war, and then a lot of supply side inflation, supply driven inflation. So this is kind of different somewhat to the 70s, by the way. So the Second World War, of course, supplies weren't available, people competed for them. You then had increased prices on various commodities, very similar to what we've seen of late. So if we look at all of this anyway, we can see here in the end of the war, at the end of the war, should I say, we had bouts of inflation and interest rates rose somewhat, but they then sank back down as the economy was trying to recover and work its way through to some sort of normality. And it took till 1955 or thereabouts for the economy to kind of get back on its feet. So we've got triple whammy, I suppose you could say. We've got Ukraine and all its consequences, Brexit, which is a long-term economic hardship in this country, and then we've also got COVID. And you mix in the three, it's really the equivalent of a war. So my baseline thesis is that when an economy is not doing great and those that be want to stimulate, the way you stimulate is by reducing interest rates. But the Bank of England don't want to do that right now because they say there's continued inflation. If Bank of England raise interest rates too high, then they cause widespread destruction. And this is exactly what happened in the early 90s when Bank of England raised interest rates to 15%, and it caused probably the biggest single cycle of bank repossessions in modern times, certainly since the war that I know of anyway. So that's the broad thesis there. Now, if we go back to this chart, or we have a look at this chart, this is real house prices. So far what I'm saying is there are property cycles. We have increased interest rates, which makes property unaffordable. And here's a more recent chart showing inflation and base interest rates. It's very, very similar to what we saw in the Second World War, thereafter, just after the Second World War. There's another chart here, this one here, which is mortgage rates as percentage of take-home pay. And what we'll see is that mortgage rates are going to gradually creep up to around 35–40%. But the difference between now and say 2005–8, that kind of period, is that a lot of people are on fixed rate deals, many more so than there were in the past. And as those deals elapse, then the average mortgage payments as a percentage of take-home pay will go up. But the reason we're not seeing such an immediate cause and effect shock with raised interest rates is fixed rate deals. So, okay, we've got that. So now we have increased unaffordability, but we have this issue with real house prices not really declining that much. Now, if we go back here, we can see, it's quite difficult to see, but this is the most recent period, and we can see that real prices are declining slowly. That's nominal. So there's a big difference between nominal and inflation adjusted. Nominal means it's the number. So the house price goes up to whatever it is, 400 and something. It drops by 20,000. That's a nominal decline. But a real decline is where you adjust the price of property by inflation. And this is something we've always done at Investmore, because whilst it's comforting that the nominal price of your property may not go down, as it did in fact in 2008, but in this case, what's happening is that the real price of property is declining massively. So this cycle, we're seeing real house price declines, but not everywhere. And I'm going to show you some charts in a minute, just that's got the latest latest property price data from Office of National Statistics, just showing you how prices have moved around area by area. So we'll go micro on this in a minute. But the main point, I suppose, that I'm getting at overall is that when property becomes affordable again, the market surges again. It goes through a period of decline, and then as affordability improves, confidence returns, and then we have it all over again, as we've had for the last 150 years or whatever, 170 years at least, ever since the modern economic system of banking and borrowing and home ownership has existed. There have been property cycles. So people, by their nature, tend to push things as hard as they can, and then they go into a period of pain, as demonstrated in this chart here, where it's unsustainable. And we're reaching that period. So there's probably a year or maybe 2 years of effectively unsustainably high mortgage payments as a percentage of take-home pay, and it's going to cause a lot of pain. But what's happening is that over time, because inflation remains relatively high, house prices, when adjusted for inflation, are dropping really quickly. And that's the thing I would ask you to really consider or to watch out for. So when prices get down to, say, 250, for example, average, when adjusted for inflation, then when interest rates finally drop, as I expect they will, based on historic precedents, based on the general consensus of economists and so on, then you're going to have another surge in the market because the affordability will be there. And then, as before, with all these other property cycles, people work in a herd mentality. They start competing because they feel confident, and then they start to bid up the price, and they get caught in a frenzy. So we saw this last year, and we'll see it again in the future. So right, that's roughly where we're at in the overall cycle. The question is, where is the market at in Manchester, and where is their value? And so my general view is that if you can get a high enough yielding property, then, and you buy it with cash, and you just wait it out, when interest rates drop, the property that you own will be worth, it'll start surging. So my guess is that it'll creep up by, well, you see, there's the question. Will the market surge again, or will it behave like it did in 2008? History never repeats itself, but it does rhyme. And the issue with 2008 was lending was virtually impossible to get hold of because banks were very fragile back then. But this time around, banks are really willing to lend when interest rates stabilize. So that at the moment, they're not lending because they're worried about more interest rate hikes. However, they're better capitalized and they're more willing to lend. So my view is that when interest rates subside, banks will be rushing to lend money and the market will surge. So in practical terms, you buy a property for 150,000, you put in whatever the money is, you rent it out, get a decent valuation on the rental, then you should be able to refinance at 75% LTV, that kind of thing. And you should be able to get most of your money back out. But you're going to have to wait for 2 years or something like that. But The issue is that if you wait 2 years and then get in, then you're competing with everyone else and their donkey, and you're just going to be picking up scraps unless you're willing to bid high. Whereas now, whilst there is competition for property, the reality that I see, and this is what I want to double check with you guys, the reality I see is that you can actually get good properties at a fair price, considering the backdrop of fear that's going on right now. And I think, oddly enough, now is a great time to buy, as long as you're selective about what you buy. What's your thought, gentlemen?
So yeah, we sending offers, and with the properties, good properties, still selling over the asking price. So yeah, so
What's
the
a
market
good property?
what do you mean? Good properties.
What do you define as a good property? Because there's a bad property, a good
yeah,
property.
yeah. Good property is great location, no risk, yield, good yield. So that's like without risk property, which will generate a great yield, around 6 or +6, with in a good area, good demographic, low crime, no flood risk, no coal mining risk, or there is no location
Okay,
risk.
so
Like
there's
next
no
to
there's no fundamental compromises with the property. It's just a clean
yeah,
property.
yeah, and also structurally the property is good, so there is no serious condition issue, for example. So now these properties are still selling more than the asking price. Yeah, the market is still hot. Not so many viewings, like in the past 30 viewings and like 5 offers. They have like 10 to 15 viewings, but 2-3 offers. So if the vendor achieve what he wants, he sell it. So
Tom, what are you seeing?
Okay, so first of all, for people like me who don't do a lot of data, I just want to try to summarize what you said and see if I got it right. So basically, you're saying that the market has slowed down, which we can see. Property real value is dropping. However, mortgages are high, so people are not buying, which means that if you come in now with cash,
Well, they are buying. Yeah, people are
buy
buying.
a house for a good price because they've dropped in real value.
Yes,
And
real value relative to wages, but the cost of ownership is high at the moment. So the cost of ownership with debt is high, yes.
Inevitably, mortgages will come back with low interest rates, which means everybody's going to come back in to buy, which means the property value is going to go up.
Yeah, so there's a longer term story. Just a couple of things come to mind. One is, if you look at Japan, Japan has a really aging population, which we all know about. But what happens with older people is they save money and they hoard, basically, because they don't know when they're going to die. And this is exactly what happens in Japan. And so even though Japanese interest rates are 0 or below 0 sometimes, depending on, the reality is that they have to do this to stimulate the economy. Now, if you look at our demographic story in this country, we've got an aging population, a sick aging population as it happens. And old people hoard money, and therefore they're not spending. And therefore, if they're not spending, it subdues inflation. And therefore, with low inflation or ultra low inflation, but governments wanting to get money moving, because that's what a healthy economy is all about, money changing hands and economic exchange, basically. What you'll see long term in this country is lower interest rates, because there just won't be the spending. Young people will be will decline in proportion to the aging population, and we see this already, that the ratio of pensioners to working people is increasing. And that's a whole separate video in itself, the long-term demographic story. But suffice to say, long term, there will be low inflation. Basically, there'll be low interest rates because there'll be lack of spending, lack of inflation because of just hoarding money, essentially. So that's that. The other thing, which I forgot to talk about, which is pretty basic, is the rent crisis and the fact that you get amazingly good yields, but you get risk. And this is always a thing, risk and reward. So the yields are extraordinary at the moment. Like certainly yields are very healthy in certain places, not London, but in places like Manchester, which has got a young population and growing and doing very well relative to numerous cities, like outcompeting places like Sheffield, Newcastle, Leeds, Blackburn, loads and loads of cities in the north. It is the star of the north, really, in my view. Anyway, people want to live there. People can't afford to buy property because mortgages are prohibitively expensive. But there's a lot of cash in the system. So the guys are seeing this because property is still hot. Uncompromised good property is hot, and there are cash buyers out there buying these properties up, and that keeps the market strong. As far as it goes with the landlord population, they're declining because of the tax changes that were made 6 years ago now. And what landlords are doing is just they're getting out, and new landlords are being either outcompeted for property, or there's just less landlord interest, and so there's less and less rental property around, and it's causing a rental crisis. The idea was to professionalize the rental market, which was a nonsense, but that's what they tried to do. And so these big corporates came in and built large build to rent schemes, but that's not really, those will be the ghettos of the future, of course, but they're not really a solution because they only work where there's sufficient density of population. But if you're in the outskirts of a big city and you want to live out there, you can't live in a big block because it would never get built. So the economics is very messed up with this thing. And the net result is that if you're brave enough to stay in the game as a landlord, you get amazingly good yields. If you're brave enough to buy in the market now, you get actually very nice properties. And if you're sensible and you convert to HMO to absolutely kick ass with yield, well, then you're the clever one, because if you do it right, you can turn it back into a family unit or something in the future and sell it for a handsome profit. So it's all 101 investing, all of this stuff. Anyway, have you guys any more comments before we get on and talk about the property, our specimen property?
Yeah, you ask how is the market out there, and as Martin said, it is hot, but it's not like last summer where it was impossible to buy. So you got a lot of choice now. As long as you put a decent offer, which is still a good price, you can get the properties. So it is a good time to buy. You don't get ridiculous deals because they are selling, but normally you don't need to offer crazy money for them. It's just a matter of a few £1,000s over the asking price. Quite often
And
we'll get
so with clients, how are they behaving with these kind of offers? Like, are they being brave or just?
It's difficult. I think somebody buying a property, you always want to get a good deal. So it's a natural reaction to one.
Oh, you mean people are greedy and they're not actually looking at the fundamentals? They're bidding emotionally. Is that the issue?
Maybe. I think you always try to offer less than the asking because you think that's going to be a good deal. But the important thing is to see at what number is a good deal. Doesn't matter what they're asking for, which number makes sense. And if that is over the asking, then that's still a good deal. So it's not just about saving on the asking price.
Well, sorry to be rather brusque about this, but a good investor has a yield number and understands the risk associated with it, simply. And they know their figures, and they bid up to a certain amount on a property, or they offer up to a certain amount on a property. And if it goes over the line, well, okay. But they look at things objectively because they're prepared, they're ready to go, and they know where they know their thresholds. Let's have a look at this property. I'm going to share my screen and you can tell me all about it, guys. So here we are. Now, these days I'm doing a lot of work with stamp duty reclaims, And I can tell you right now, this would be a choice property for stamp duty reclaim. Anyway, what's the story with this, Tom? You were there, weren't
So
you?
this was a property that it was really good to convert to HMO because of the size of the house. Yes, it does need work, but it doesn't matter because we were going to do the work anyway to make it into an HMO.
Mm-hmm.
It met all the criteria in terms of area, and maybe Martin can talk more about that. Close to transport, close to amenities. This one, I think it was 5 rooms we could have gotten out of it. So it was perfect, and the price was good. It went over the asking.
What was the price?
It was 180 was the asking. It went over, but it was still a good deal.
175.
Yeah, it was still a good
it
deal.
was 175 asking.
Right.
Okay.
So
What
I think
was
the
the road?
mistake
Just out of
here was
interest,
not-
what was the road noise like around there?
It is close to a motorway. So outside the property, it is a little bit, you can hear the motorway.
Mhm.
But I think when it comes to HMO, I think people put up with more of these things because the main interest is, are they close to transport, are they close to amenities?
Mm.
It's not a family that's going to live there. It's an individual person. And they're going to an HMO because of convenience.
Yeah, because it is a very good location. So, all right. So 170. What would the refurb have been?
Around 70K.
Right. And would it have been? Was there any? Did you do any floor plans for this or anything like that?
Yes, we did for 6 beds, but after we spoke with Niraj about he suggests to be better 5 beds. And 1 bedroom will be like 24 meters squares. So that room will be like our own apartment, really large. And
24, 240.
meters,
20,
no, 24 meters.
It is
square.
about 204 square foot, yeah.
Gosh, that's big.
Square meters. Yeah.
Yeah,
Mm.
it's really a large house. Each room will be around 18 meters square or so. So he said this will fly for renting. Like it was amazing deal for HMO.
What kind of yield would it have got then? So assuming it's what 200, you're in for 210. Let's say 220 with fees and other bits and bobs, or 225, I'll call it. What would the yield have been?
The yield with 5 bedrooms will be around 8 net yield, including maintenance invoice, including management, including utilities, and it will be around 14 gross yield.
Okay.
40%. Yeah, it was really great. And the kitchen was in reasonable condition because there is an opportunity to make it 6 beds, but you need to connect the shed house behind the house and the kitchen
Right.
to make it larger. But
Yeah.
it doesn't work because the kitchen is in reasonable condition.
Yeah, you would preserve that, wouldn't you?
Yeah.
Nice little backyard as well. So let's have a look at the location for this. The property is here, I think. Yes, on this road here. So you've got that. It's not actually, that's an A. Is that a motorway? I don't think it is. I think it's an A road, isn't it? A fast A road.
It's a dual carriageway.
Yeah, not a motorway as such, though. So it's a dual carriageway. Busy dual carriageway, but it's not a motorway. Like motorway would be the next level up with noise and stuff. But anyway, it doesn't actually matter, as you point out, because it's an HMO, so they don't care. And what, you're about 5 minutes away from the train station, I assume?
Or even less, yeah.
That is a train station, isn't it?
Yes, correct. Yeah. And the distance from this train station to Manchester, which is really like surprising, it's really close. Transport is taking only 28 minutes, or sometimes it can take 21 minutes. So, for example, if you live in Salford and you're taking a bus, it can take you 25 minutes or 30, and from this location can take you 21 minutes, which is amazing. So, the location, it was amazing for this one.
And what's the postcode again? BL9 or something, wasn't it?
BL4.
Yeah.
7 RT.
Right. And what about shops and so on?
The shops are like, yeah, you have Asada, you have close by, not so close, but 10 minutes.
It's got convenience stores local though. That's great.
Yeah.
So it's got a local stores and just it's a quiet area, but good for town. 8%. So anyway, this kind of yield, to give you context on this, if you were to buy a property in London, for example, you might get a 4% yield, gross yield. Yeah, but obviously cost of interest and stamp duty, just 4 to 3%. So for example, I know of a property that someone's renting out in central London and it gets a 2% yield, but it's a very grand property in the middle of town, but yeah, terrible yield and not much capital growth either. So if you're buying a nice property in Altrincham, then you would get a 4.5% yield, would you say? Somewhere around that? So
like
typical above 250 grand house, it's going to be 4.5%, 4.25%, something in that region. So they were the numbers I remember seeing a lot of when we were looking at higher end.
You can find somewhere for 5.5.
I think the point is that the other thing to remember with yield is that there's a clear correlation between risk and high yield. And what, if you imagine a chart, what one wants is high yield and low risk. So if we say low risk, low yield, high yield, then we want to be in that corner there somewhere. So we want low risk, high yield. And the reason we chose all these HMOs as a thing is because they are the lowest risk, highest yield way of making money. And they're very financeable when it's ready to finance. So I really like them. And that's where I want to put my personal money. So there it is. Okay, any final comments from you, and then we'll sort of summarize and finish up.
No, I think you summed it up. One thing to bear in mind is you can see deals for HMO with higher yields, but there is, as you said, you have all the risk. There'll be areas that actually don't work. The numbers look good, but then who's going to live there? How are you going to rent them? So the trick is, like you said, is get that sweet spot where it works and you get a good, decent yield.
Yes, exactly. Yeah. So I think people underestimate the importance of good tenants, and this is especially important for the future with the rent reform bill. But and of course, issues like this and the change in taxation are driving a lot of landlords out, but then it drives rent up, and therefore, if you can stay in, you can win. The thing is to be super careful about where you buy so that you attract the best kind of tenants who give you the least hassle possible, versus what it advertises as ultra high yield, but is in fact unrentable because it's in the middle of nowhere or in some over rented area in Liverpool. Okay, so the one thing I forgot to do, which I'll just quickly do, is just talk about the short-term ups and downs in the market in terms of capital gain and so on. So I think that's something people are quite interested in, I guess. And this is the data from Office of National Statistics. No, sorry, Land Registry. And it's up to September last year, which is the most recent. So there's always a 6-month lag with the data. But it's quite indicative, really, and it's the year-on-year capital gain. So the number represents the year-on-year capital gain up to the most recent data we've got. And then if it's a red color, that means there's a lot of gain, and green is less gain. And
Nick,
so,
can you make the numbers bigger? because
Yes.
I think
Right. So it's quite difficult to make sense of this because it's so zoomed in. But here's Manchester. And there is green around the place. What you notice here is that areas down here doing this little patch is Withington and M20. I presume this is expensive. Yes, it is. So these kind of places are suffering because cost of money, basically. But there are lots and lots of areas around the place which have remained quite robust, in fact, over the last year preceding September 2020, 2022. And obviously the market will have come off from then a little bit more. But what were we going to say, Martin?
Yeah, Dresden, for example, is really good location where the capital growth is still strong.
Yeah.
143.
It's because people with cash are buying. And those with mortgages are probably getting relatively low loan to value mortgages. And when mortgages are available, they're buying too. Liverpool is also fairly strong. It has its weak spots, as you see, like Manchester does. But the issue with Liverpool, I think, is that it's a smaller conurbation. And overall, when you look at the long-term story with Liverpool going back 20 years or whatever it is, then it's a less good story. If you see a lot of red, this is really current data going back the last couple of months, basically. And it's for postcode district. So if we zoom out a little bit and look at Manchester, yes, there are a few patches. M40 doesn't seem to be so healthy. M6, not so good. This is adjusted for inflation, by the way. But overall, there are lots of patches, especially further out in Manchester, which are doing great, like BL4, where that HMO is. So strong air, that whole patch is good because there's genuine value there. So anyway, there it is. That's the capital gain story. There is gain. There's a healthy market. But as I said, when you look at the long-term story and you look at how affordability is returning because of the relationship between house prices and inflation, once those interest rates drop, the market will surge. And the key thing, if you're a smart investor, is take the opportunity whilst it's quiet, relatively speaking, and get the most choice properties possible where the demographics are good and where you'll see a lot of capital gain in the years to come as money gets cheaper again. And by the way, you'll get a lot of income out of it. Okay, any last words from you, Martin?
Yep, I think this just final words. I think it's still a good time to buy a deal. So because of the competition is not that high, and the competition will start rise up again soon when the interest rates will back. So if you have cash, I think now it's the best time to buy.
What's your opinion, Tom?
Sorry, I'm muting. There we go. Yeah, I completely agree. I think it could be scary for some people to buy now because they think nobody's buying or maybe slowing down. But as we just seen, actually, this is the best time to buy because this is where you have the choice to buy, get a decent deal at a fair price. And as we've seen, quite likely prices are going to go up.
Yeah, well, it'll be like post-World War II, where the economy is weak. And when you have a weak economy, you cannot throttle interest rates too much. Otherwise, you cause a catastrophe. And any economic historian will tell you, if you look back in the great crash of 29 and that following period, there was just too much damage done because governments essentially pulled back so hard with high interest rates and so on. It turned what was a bad crash into a depression, and governments don't want that to happen. So what they do is they pull back before they cause massive destruction. Anyway, there it is. Right, you know the thesis, you know where we're at. This is our genuine view. There it is. Thank you very much.
Thank you.